throughout history, who controls the money controls the world. And since 1944, America has controlled the money, with the US dollar being the reserve currency of the world, which caused America to boom, but it also caused many problems. And when we lose our reserve currency status, the question is what happens after that?
Well, I think the first thing people need to realize is the banks control the money, and more specifically, the banks outside of the United States.
Amen. Yeah.
The reason I start with that is so people realize that 95% of the dollars in the world were created by lending them into existence. And therefore, those dollars are a liability of a bank. They weren't putting it in a vault. They were actually taking your money and they were lending it out, and you just had to trust that that bank was going to pay you back.
You have your asset. So you have $1 million or 100,000, that's your asset. But the moment you put it in the bank, it becomes the bank's liability. The banksters have to then take your money and they have to buy another type of asset to make sure they can pay you the interest on your savings here. The bank's assets went bad, and that's when the runs of the banks start. People want their savings back. And the big concern with Fed coin, the central bank digital currency, CBDC, is that we lose our privacy. They'll track every move because they'll know everything we're spending money on, what we spend it on, who we give it to, and all this. And that's the problem with central bank CBDCs.
What a CBDC really is, when you look at the mechanics and the financial plumbing, it's just the individual taking their account and simply moving it to the Federal Reserve. This is what we really need to push back against, assuming that you value freedom, liberty, free market capitalism, and especially your privacy. Because all those Orwellian things that we have heard of that we don't want to come to fruition, those cannot happen unless your dollars are on the Fed's balance sheet, or said another way, that your dollars are a liability of the Federal Reserve. And fortunately, the good news is that is currently illegal. So as long as we make sure that they don't change that law and they don't break that law, it's going to be very difficult, if not impossible, for them to implement what is really a central bank digital currency. But let's keep in mind, there's roughly $18 trillion in deposits in the United States. That math doesn't work when the FDIC only has $200 billion.
It's like the big house of cards is set to come down.
Again, that's my concern, that the central planners, the Marxists, are going to leverage that crisis situation. Their motto is you never let a good crisis go to waste. So if we continue to see problems in the banking system that exceed the FDIC's ability to patch up the holes, then of course they come in on their white horse saying, well, we've got the solution. All you have to do is take your dollars from these unsafe commercial banks and just move them to the safest bank in the world, which is the Federal Reserve. And people see that as, oh, that little bit, that perceived security and safety, they give up their freedom. But what they don't realize is they're doing a deal with the devil. I use the example of a tsunami. We know that a tsunami, when it's way out at sea, although you have this powerful force that's coming at land at 100 miles per hour, you can't see it. Well, they don't know exactly when it's going to hit. They don't know where it's going to hit or how it's going to play out, but they just know this thing is headed at you at 100 miles per hour. That is basically what the yield curve does for us.
The crack in the foundation is now showing, and how fake this whole system is. That just creates money out of nothing. And when America started paying its bills just by creating money out of nothing, the American empire is going down. And that means the dollar is possibly going down. And what happened was then the banks have to buy something to cover the interest they're paying you. And so they bought all these T-bills and this and that and all this crap. And then all of a sudden people realized the bank couldn't cover it all. And that's when the savers start running back to the bank, give me my savings back. And that was what Federal Deposit Insurance Corporation was for, to make sure that they would give you money back. But these banks had created so many fake assets out here, they couldn't cover it.
What we can see is the 2-year Treasury yield is higher than the 10-year. So just right off the bat, if I ask you, Robert, if you're going to lend someone money for 30 years, are you going to charge them a higher or lower interest rate than if you lend them money for 3 weeks? Well, the answer is going to be a lot higher interest rate because there's a lot more risk. So when we see the short-term interest rates higher than the long-term interest rates, that's the economic tsunami warning signal saying, hey, something is really, really wrong. And most likely we're going to have a significant recession or depression in the near future. And this is what that yield curve is telling us. So what people really need to be cognizant of is when the 2-year yield goes back down below the 10-year, because when the yield curve is no longer inverted, that's when we usually get the recession or economic depression.
People say, oh, good, the 2-year went down below the 10-year. And everybody thinks that's good news, but it's not good news for the average person.
Yeah, that means that the tsunami is not 100 miles away. That means that the tsunami is 100 feet away. The next thing that you need to look for is the curve no longer being inverted, which would mean the 2-year Treasury yield going back down below the 10-year. You see that 9 times out of 10, financial economic tsunami hits the shore after the curve is no longer inverted. It's a result of the Fed actually dropping rates. And for those people who aren't prepared, that's when they're going to get financially destroyed.
So what advice would you have for people right now? How do you prepare for this giant tsunami? I think it's the biggest in the world because it's global.
And to think we've only hit the tip of the iceberg after all these entities were bailed out, the yield curve is still sending us the exact same message, saying, hey, you guys think the Fed solved the problem, but they didn't even understand the problem. So getting back to your original question, though, I can just tell people what I'm doing with my personal portfolio. And I'm not all in cash, but I have the biggest cash position that I've ever had. And I make sure that I've got, 10% gold, physical gold. With the cash position, I'm currently in short term. That's very, very key. Short, just 1 month, 3 month, very short term treasuries, because those are a liability of the government. They're not a liability of a bank. And if you're worried about the banking system, that's that counterparty risk that I'm trying to avoid. And the good news is that for those who are paying attention, we have this warning system.